Hey, does inflation have you down and out? Well, it has me worried. That's why I put together this video. Talk about inflation, what it does to us, and better yet, how we can beat it. You ready? Let's go.
Welcome to No Zoom Mondays, the channel that teaches you how to retire earlier and enjoy retirement more while you're in it. Please like, subscribe, and turn on notifications so that you'll be the first to see the latest videos.
Wow, everywhere I turn these days, the prices of the goods and services I consume are going up. I mean, everyday things like headed to the gas station to fill up my pickup truck with gas, headed to the grocery store to buy fruits, vegetables, meats, or just going down to the local retailer to buy some clothes or camping equipment to go out on one of our adventures. Everywhere I go, prices are going up. And with prices going up, that's what we call inflation today. And you know, inflation isn't a good thing. It actually causes us as consumers a loss of our purchasing power, meaning the more inflation happens, the less we can buy with our current set of dollars. It's just not a good thing. And we have enough problems in this world today already, right? And then we got headlines like this: 8.5% CPI. Wow. Have you ever wondered what the heck that means? Well, that's a great question. First, let's look at the CPI part. CPI stands for the Consumer Price Index, and it measures the cost that we would pay for a fixed basket of goods and services. Governments take these measurements every month, quarter, and year and evaluate how their local economies are doing. What's in that CPI basket of goods and services, you ask? Well, that's another great question. As you can see from this graph, the actual CPI index consists of 8 major categories, all listed here. I'll only cover a couple of these. The biggest one, as you can see in the far right-hand corner, is our housing. That's the cost to buy a house, to maintain and operate that house, etc. It's a big portion because it's a lot of money. The other components you can see above that are food and beverages. That's significant at about 15%. That includes the cost to go buy groceries, to eat at home, to go out to a restaurant and eat. Far left-hand corner, you see transportation, another big one. That'd be what it costs us as a consumer to buy a new car or a used car, to actually cost to operate it, to things like gas and the repair costs to repair and maintain that vehicle for safety on the road. You've got the other ones above that: medical, recreation, education, communication, etc. All fit the CPI, and this is the fixed basket of goods and services that the government looks at monthly, quarterly, and annually to calculate whether our prices are going up and down in the locales. So before we jump off of the CPI, I'd like to talk about 2 other variants that you'll see talked about in the media. Core CPI is the same 8 categories that I just talked about, but the government gets rid of the food and gas components because they're so volatile, so that it gives them a base of inflation or price increases to look at that are a little bit more moderated by things that are under their control. The other variant is something called the personal inflation rate, and that's one that's really critical and one I'll continue to talk about later in this video, so stay tuned. Well, now, why does CPI matter to us? Well, as I noted in that news article before, it stated that CPI had jumped 8.5% year over year. That means that that same fixed basket of goods that I just talked about, those 8 categories, has moved up by 8.5%. So what might have cost $100 last year, this year you'd be spending $108.50. So costs more, costing your purchasing power to go down with the current dollars we have. So the CPI and the increase actually directly affects our wallet, which could be bad news. So what else could be bad news if prices are increasing and inflation's way up? Is the governments quickly try to reduce our consumption, the demand we have for these goods and services, with the hopes of reducing inflation, ergo price increase, by increasing our interest rates, the rates we pay on loans we take out to buy stuff. And in this case, in the United States, our central bank is the Federal Reserve, and they have already started to do an increase in rates. So what that'll do as a negative impact to us as consumers is actually cause us to spend even more money if we're taking loans out to buy stuff to pay those loans back. Not a good thing if we do that. Well, now that we know our prices are going up, i.e. inflation's up, and we know our government's pushing interest rates up, the real question is what should we do about this? Well, that's $1 million question, to be honest with you. Each of us needs to have a financial plan that allows us to keep up with inflation and preferably beat it, to make sure we don't lose our purchasing power and not be able to meet our financial goals and never get to retirement, etc. The goal would be to put in place a financial plan that allows you to beat inflation, to be able to hit your financial goals and get into retirement sooner, go off and enjoy those beaches, those vacations, that golf, all those things you want to do sooner rather than later. And that's what we're talking about next. Yeah, so we want to beat inflation, right? Well, I know of 3 main areas that we can do just that. The first area, most important, is maximizing your income today. That means if you have a job, you need to go in and ask your boss this year for a raise. A raise, in fact, that beats the inflation rates we're seeing out there. You're in a great position this year. There are over 5 million new jobs that are open right now for people. So go in, lose that leverage, and ask your boss for a raise. If you're sitting there and you're thinking about switching jobs, it might not be a better time than now. Given the fact that there's all these openings, you could go jump jobs and actually increase your salary that way. You know, if you're staying in your job and you're in sales, like I was for many, many years, all we got to do is sell more, right? Get more commissions, beat inflation that way. And of course, last but not least, if you're in retirement like myself, you could end up going back and getting a part-time job or maybe full-time work for a while to beat out this inflation, get your expenses down along the way. The other thing you could do in retirement, like I'm doing, is start a small business. No Zoom Mondays, for example. I'm hoping to generate some income on this to be able to help offset the inflationary pressures we see today. Remember, more likes and subscribes will help me generate that income. Now, the second main area we can work on to beat inflation is around the area of diversifying our investments. That means our investment portfolio should include things like stocks, bonds, hard assets, etc. In fact, conventional wisdom states that there are 6 things that we can do to make sure we are sufficiently diversified to minimize the inflation risk on our assets. The first thing I can do to make sure I've diversified my investments is to have a mixture of stocks and bonds. Not just stocks and not just bonds, but a mixture of both. And in fact, in that, conventional wisdom states clearly that you should have a heavier mix of stocks than bonds so that you can end up having a better chance of beating inflation. Stocks grow faster than bonds and return better than bonds. So that's why you want more stock. In my portfolio specifically, I have a 70% stock and a 30% bond mix to make sure I stay up with inflation. The second thing you can do is allocate a portion of your stock percentage to value stock funds. That's because, in theory, value stocks actually have good fundamentals, have current cash flow, and that will continue to help you stay up with inflation. In the case of my portfolio, I bought value funds inside my stock percentage as well. The third thing we can do is to buy bonds that actually have a shorter term to maturity. You can get bonds in time frames of 30 years, 10 years, 5 to 7 years, or even shorter. The longer the bond's maturity, the worse it will do in inflationary times. So we want to go with shorter term maturities on bonds. And in my case, I went with intermediary term bond funds that have a 5 to 7 year maturity. The fourth thing we can do to beat inflation is to buy into funds that match what the market is returning. That means we don't buy individual stocks or bonds. I know in my case, the history that I have buying individual anything usually turned into a negative investment. So going forward, I believe in the theory that you want to buy and get a well-diversified, exchange-traded funds, both stocks and bonds, and just expect market returns. The fifth thing suggested to beat inflation is to own hard assets within your own portfolio. In this case, the best thing to do is own real estate. Why real estate? Well, real estate allows, as you rent the places you buy, you could actually charge higher and higher rents, thereby giving you a better return and a return that might keep up with inflation. However, in my case, I'm a big proponent of owning a home, and I've owned several in the past. Today, I don't want to own physical assets where I have to actually touch them, get renters to actually do repairs, do all that time-consuming work. Instead, I've invested in something called real estate investment trusts, or REITs. Those REITs allow me to passively capture, meaning I don't have to do anything, returns that the housing market or other commercial buildings might provide. Last year alone, the REIT that I bought into in my portfolio produced over 40% return passively. So I suggest the same for you. The sixth thing suggested to do to beat inflation is to seek a higher return for the cash you might have on hand. As I've mentioned in previous videos, I keep an emergency money bucket in cash. Mine happens to be 3 years total value, and in that I've looked to move it from a bank savings account paying paltry interest rates to a brokerage firm's money market fund, so I'll get a higher return on the cash that I have than I would by leaving it in a bank account. I would offer that the return might not be as high as inflation will be, but it certainly is producing more money than by leaving it where it was. So, given all these 6 things, you might be asking, well, what did your portfolio actually produce, Jeff? Well, in 2021, that portfolio actually generated over 16% return. Last year's inflation from January to January was stated at 7.5%. If you remove the 7.5% off the portfolio's total return, my real return actually ends up being 8.5%. Fantastic in the view that I actually only need 4% a year to be able to live the retirement lifestyle that I want. If this continues, I can do this in perpetuity. If you'd like to know exactly what my portfolio consists of, the funds specifically, and the allocations within each of those funds, please take a look at this video and the links in the upper corner as well at your leisure. The last thing I'll ask is, throwing it back to the viewers out here, several questions come to mind for me that I'd like to get some feedback on. One, in my bond portfolio, I keep hearing about TIPS, Treasury Inflation Protection Securities by the U.S. government. Curious if anybody's got those. I know the returns were very low for a while. Perhaps it's now time to look at that as a way to help beat inflation. A couple other things come to mind. I've heard friends talk to me about being in gold and silver as a way to do inflationary hedges. I've yet to do that. I'm interested in feedback and seeing if others are doing that and how that's working. And last but not least, the famous Bitcoin is out there. I've heard that is maybe a lever to help beat inflation as well. I'm looking for feedback and understand and see if others are using that and if it's working so far in regards to their inflationary concerns. Please comment so we can learn together and be better investors going forward. The third main area that we can work on to help us beat inflation is the area of minimizing our own spend. This takes me back to what I brought up earlier in this video, something called our personal inflation rate. You see, we have control of how much inflation really affects us by how much we spend. The less we spend, the less inflation affects us. And that's the great news. The other thing we can do is take that money we save by not spending and actually invest it. The market happens to be down some. If you're investing in a down market, you're actually doing fantastic as it starts to come back. In fact, I've got a lot of ways that I'm minimizing my spend, and I want to share them with you right now. So let's go. The number one thing I'm doing in 2022 to minimize my spend is I'm not taking out any new debt. Zero. I don't need a vacation home. I don't need new furniture. I certainly don't need a new boat. None of that, especially if I have to take new loans out or get more debt to make that happen. For me, I want to minimize the inflation bite, minimize my spend in this front, and minimize the personal inflation rate that I'm going to see. Another area I looked at was to minimize my spend on my communications part of my CPI, or personal inflation rate. I ended up calling my wireless service provider, trying to find some discounts I could take, and lo and behold, I was able to save over 20% off my annual bill. Here's the video. I talk about how I did it and what I used to make it happen. The link's up top. I hope the same happens for you. Did you know another place to minimize your spend is actually in the grocery store? Not all products have had the same inflation rate as others. For example, meat and poultry have went up over 10 to 15% year over year in regard to inflation versus that of fruits and vegetables. These things only went up by 3 to 4% a year. That means the more you eat of this, less your personal inflation rate is. And the second benefit is your health goes up. The other thing we're doing around groceries this year to minimize our spend is around wholesalers for food instead of the standard retailer like this. We're headed to places like a Costco to buy food in bulk that we love and we know we're going to eat. Saves tons of money and continues to lower your personal inflation rate. The other area I'm trying to minimize my spend is in my clothing category. You know what I found is that I can pick up slightly used items a lot cheaper than new stuff. Take a look at this. I needed a new shirt. I found one right here, $9. Pakui means to be happy. What could be better, right? You too can save on your personal inflation rate. Buy slightly used, they're good things. And you get great music. The other thing I find myself doing to minimize my spend this year is actually reducing my gas consumption. I'm doing that by walking more to run errands. Anything I can do with a walk, I'll do. Or even better yet, I might go bike and actually bike around to the places I need to get. It's great stuff. The other thing we're doing, Beth and I, is we're commuting together more often when we need to go get stuff done. It's the best way to reduce one of the largest price increases that we have in the basket of goods. Gasoline, it's up over 30 or 40% since last year. It's a huge increase. Reduce that spend, reduce your gas consumption, and you too will lower your personal inflation rate. Another way I found to minimize my spend this year was to minimize my stuff. Yep, who here doesn't own too much stuff? My new motto in life is the following: if I haven't touched it for a year, I don't need it. I've gotten rid of so much stuff in the last year that it makes my head spin that I had it in the first place. I offer up the following video to show you how I saved $1,500 and made money in the transaction. Hopefully you can do the same. Get rid of the stuff you don't need. It's just taking space, physically as well as mentally. You deserve it. Let it go. The last thing I'm doing in 2022 to minimize my spend is to lead a healthier lifestyle. That includes eating better food. That includes getting outside more. That includes working out more. Why? Well, because the articles I've read say the largest expense we're going to face in later years is our medical costs. They're stating over $250,000 on average is what we can expect to pay. I don't want to pay that. In fact, I don't even want to go to a doctor. That's why I'm out here doing this. I suggest we all get out. Get outdoors more. Eat better food. Enjoy life. It's short. You deserve it. Heck, we all deserve it. Let's go. That was fun to get out and about and show you how I'm minimizing my spend. Hopefully this video has helped you get to the point where inflation's not got you down and out, but actually got you motivated to do some of these things so you can get in front of inflation and have a better tomorrow. Hey, if you're interested in seeing what the first year of retirement can look like and what you should be prepared for in it, take a look at this video. I think you'll find it very enlightening.